Hi, and welcome to this week's episode of the Retirement Readiness Podcast. As always, Tim Regan, the founder and wealth partner at Prairie View Wealth Partners.
Hey, Katie.
And I'm Katie Umland. It always seems funny to say who you are every episode. I'm like, can I give this part up?
But I think it's just we have so many new listeners,
so many new followers
all the time.
Every week.
It is. We have to keep doing it. That's right. That's right.
Well, if you're still here after all of that, thank you for joining us today. Today we're going to be talking about income strategies in retirement, including annuities and investment dividends. Dividend investment. So I saw this on our calendar today and I thought, I don't know anything about that. So
that makes two of us.
Yeah. So hopefully you do. Okay, so where should we start with saying, I don't even know what an annuity is, if I'm being honest.
So, I think that's a really good place to start because I think there's a lot of confusion around annuities and how do they work and should I have an annuity, shouldn't I? And people that, if you go in the way back machine, annuities were one thing. And so many times we have people of a certain generation that remember how they used to be, and it can be confusing. And then they've only gotten more confusing from there. So, but I think that really, to put it into perspective, I think that as we talk about income streams in retirement, it really is a link back to really how do I live that two-comma life? Because if I start thinking about how do I have stability? How do I have abundance? How do I have confidence? Well, knowing that I have an income that's going to support my lifestyle starts me down that path in a big way, right? And so, and that's kind of the headset that we try to put on when we think about how much income should I have in retirement that's guaranteed, I know it's going to be there type of money. And that's really, I think, I guess the punchline, right, is how do I create that? And so when we start thinking about those income streams, a lot of times people start thinking about things like their Social Security, which is really good. It used to be people thought about pensions; those are like long gone kind of now, unless you're fortunate enough to be in a union or something like that. But many of those pension plans are gone, and so that's where maybe this opportunity to think about an annuity starts to come in. So in the base kind of sense, if you will, what an annuity is it's a way for you to say, I'm going to give money to an insurance company while it's sitting there before I take it out, while it's kind of accumulating, it's going to grow tax deferred. Then when I want to take money out, I can turn it into kind of like a private pension. I'm going to turn it into an income stream that I can never outlive. The good thing is I know I have this income. I'm never going to outlive it. The bad thing is I only have this income, right? I've now made this trade with the insurance company to say, okay, you keep my money and give me this income. And there are ways that you can protect yourself. It's not like, man, I died tomorrow and got hit by a bus and I lost all my money. But at the core, the thought is I take a lump sum of money that I have and I start an income stream that I know that is going to be there for some given period of time, usually for as long as I live.
So that would be like in addition to a life insurance policy?
Well, yeah, it's almost like the exact opposite of a life insurance because many times when I die, there's a loss of value to that annuity, not an increase in value to that annuity. And that's like annuities in their most basic, when I say annuity, what's the most base form of an annuity? And from there, when I said, it started confusing, it got even more confusing. There's all kinds of bells and whistles today that you can apply to those annuity contracts. But when you think about retirement and you think about how can I build confidence and security in retirement, one way we can do that is by layering these guaranteed income streams that you're not going to outlive.
So kind of like, I think our very last episode we talked about was diversifying that. Yeah. So that's kind of another diversification path towards your income.
Sure. Yeah, for sure. And one of the things we think about with that is, so when you retire, it's very similar to when you're working, when you think about what do I need for income? And when you think about those things, it comes in different varieties. I have things that we used to call MUG, mortgage, utilities, and groceries, right? I got to have my MUG taken care of. And that just gives me my base lifestyle. But then there's all the other things, going on vacation, spoiling the grandkids, being able to do the fun stuff that I want to do. And so many times when we start thinking about how do I build a retirement income, we start thinking about how do I protect the base. So now I know for the rest of my life, no matter what, I'm going to be able to live in my house. I'm going to be able to pay my bills. I can live my base lifestyle. And then we use all of my extra money for the extra stuff, and that's where my discretionary money comes from. So now I'm not forced into a position of living according to the stock market or the bond market, right? Where, the market's down for the last week. I better not go buy steak today. No, if you eat steak on Saturday, then you'll go buy your steak because that was built into your
the plan.
Your plan, yeah.
Okay.
Yeah. But of course I picked steak.
Yeah.
It's funny. I was just doing like I was filling out a survey. I was signing up to go out to a conference, and they asked like, what's your favorite food? They want like, let's get to know you. What's your favorite food? And the first thing came to mind, which I put down, was just meat. And so no wonder steak is the first thing that came to my mind. And so, but when you start thinking about building that retirement income, you start thinking about how do I build this base? So now if you think about just the confidence that would give you, if you knew that no matter what, for the rest of your life, you're guaranteed to have enough income to cover all of your basic needs, have a car, live in your house, that gives you way more freedom and flexibility and confidence to then say, you know what, let's go on the cruise, or let's buy a lake house or whatever.
Takes some of the question out, and it feels less risky.
It does. Now, some people, your question around the life insurance piece, some people will look at that and say, but how does that jive with my plan to leave money to my kids?
Right.
Because if something happens to me, that money could be gone. And that's where some of these newer annuity type of policies come in. So at the core, like I said, the base annuity says, take my lump sum, give me this income guaranteed. And, but when I die, I get less of that money. Either you keep it all or there's some less that I get. What new annuities will do is, instead of that trade-off, they'll say you can keep your money invested in the market. You can still, when you die, whatever is left in that account will still go to your heirs. But now what we're going to do is, instead of guaranteeing you this income, the income guarantee that we're going to give you is a percentage of what you started with.
Okay.
So it's going to get kind of confusing, but to walk through the numbers as an example. If you put $100,000 into that annuity, they might guarantee you a 5% payout, guaranteed for the rest of your life. If that annuity goes to zero, you're still getting that 5% payout.
Okay.
So that means you're going to get $5,000 a year on that money. When you die, whatever is left still goes to your heirs.
Okay.
In that kind of base annuity example, just kind of the most basic, where you say, take my 100,000 and just give me this income. Instead of getting 5,000, you might get 8,000. So your income amount that's paid out would be much higher. But when I die, my kids don't get anything. And so it's kind of these pros and cons of what's important to me. And there's ways that you can blend, leave money to the kids and have a guaranteed.
And maybe some of that also goes along with, like, we know historically mom's side has lived and well until their 90s.
I think some of our great-grandparents are still alive somewhere, right? I mean, it's like they got some long genes.
Does that kind of play into it too? Like,
1,000%. And so I think about that in our situation specifically. When I think about Sarah, she's got her great-grandmother lived 105. She's got two grandmothers that are still living at 90. We've got a great-grandfather her grandfather died in his mid-90s. You look at all these, I'm like, even if it's not me,
right,
and the longevity that we have on mom's side, between me and Sarah, we got some longevity.
Right.
That's a key place where you start to say maybe that annuity makes some sense.
Sure.
But then I also look at it and I say, well, maybe that just means that retirement for me is not as soon as you think, right? Like, it's because that's the other thing that people start to think about is, if I retire at 60 and I lived to 95,
it's a long time.
That is a long time. And not only a long time to try to figure out what you do with your life and have the purpose in your life, but it's a long time to figure out, how do I get enough money saved that I can have that 35-year stretch.
And not just 35 years, but a good 35 years. That's if you if you have a lifestyle that you want to maintain, a 2 comma lifestyle for 35 years, that looks different than a 2 comma lifestyle for 10.
Yeah, 100%.
So,
and it's really kind of where we've gone a couple of times with some of the health stuff, where you really start talking about that health span, not lifespan. And when I think about health span, I want to be 90 and skiing, right? I want to be 90 and going to Aruba. I want to,
and dancing at your great grandkid's wedding.
At that point, it could be great, right?
Gosh,
I mean, it's crazy. So that is the plan, but you only get there if we put in some pieces to give some of that security.
So, an annuity is just one, obviously another little piece of an income. So I guess when you first started talking about this, I think probably it's because of my age and, of course, my being naive. But when you think about retirement in general terms, it seems like, okay, then whatever money you have in your retirement account better last you 35 years. Like, I don't think about retirement and having income streams.
Sure. Yeah. No, that's a great thought. And because that, I think, is the default, right? The default is, how do I get enough? How do I build enough? And if you are familiar with business at all, there are two different financial statements. There's lots of financial statements, but two in particular that you look at, and you talk about your income statement, you talk about your balance sheet. Your balance sheet is all about, and this is for people too, but you see it many times in business. Your balance sheet is all about, what are my assets? What are my liabilities? How much am I building in my 401k? Those types of things. Your income statement is, how much money do I have coming in, from what sources, and where am I spending it, right? Kind of like a budget. And so when you think about retirement planning, it really is both of those. Like, both of those are the problem. I have to build my balance sheet so I have enough capital behind me that I can make it last forever. But really, what we're talking about is an income problem. We're talking about, or you can think about like a cash flow problem. How do I get enough cash coming in so that I can live for the rest of my life? And whether that's previous episodes we talked about, like with franchise, when we had Jason on and talked about, what if you owned a franchise and that generated some income for you? You can talk about an annuity and how does that generate income for you? Some people look at rental homes or rental property, like when we had Dave Cobb on, and talk about, how do I build some income streams from other sources? Some of those are financial sources like dividend paying stocks, bonds, annuities, those things. But to your point, it really is, how do I have the income streams that I need to sustain myself?
And that doesn't mean having a job. Like,
no,
when you think
it
of
doesn't have
streams,
to. Yeah, that's right.
That's what I would have thought of. And it's kind of like making your money work for you.
Yeah. Well, or, you just have successful kids, right? Yeah. Hey guys,
find a sugar daddy.
For 18 years, we supported you. Now we're going to switch this 18 years the other way.
Okay. So the first half, we wanted to talk about annuities. The second half, dividends for investments. So what does that?
Well, and that's really hard because, sometimes people will look and say, a great way to generate some income is, I'm going to go out and buy dividend paying stocks, or maybe I'm going to buy some CDs that pay me interest, or bonds that pay interest, which are great ways to generate some income. The downside is those aren't as stable as other forms of income. And what I like to look at, especially, as we're recording this now, we're in February of 24, and interest rates in the last 12 to 18 months have gone kind of crazy compared to what they've done in the past, meaning the degree by which they've changed has been very rapid compared to what they normally have done. And so if you look back 18 months ago or so, you could go out and buy a CD and it would pay you 1%. Now you buy a CD today, you can get 4.5%.
Right.
And so one of the downsides to trying to bank that on those dividends and that interest for your retirement is, if you're retired in the 90s, those interest rates you're paying on your CDs probably 6%. Mm-hmm. And that goes all the way down to 1%. That doesn't work really well. You right. have to have a whole lot on your balance sheet to make up for virtually no interest. And so that's why it really has to, when we talk about diversification, yes, we can have some of those things generating some income, but we have to diversify as well and make sure that we've got investments that are going to outpace when interest rates and dividend rates go down.
So that's maybe more of a question when you're thinking about retirement, when it's in the distance, is what investments you're making.
Well, it's really, how do I build those investments? How do I grow those investments? And then when you get to retirement, the way that we like to picture it, and usually I'll draw this out because it's easier to see kind of as a visual, but what I like to think about is when you need your income in retirement. Think about, have you guys ever gone to like the Wisconsin Dells or
Yes.
a water park? So at all these water parks, usually where the kids' playground is, at the top of it, they have this big
Ding,
bucket.
ding, ding, ding,
Exactly,
ding.
exactly, right? This big bucket that's filling up with water. About every 10 or 15 minutes, you get the dinging that goes on. All the kids come running because the bucket then tips over and splashes this water all over them, right? And we kind of pictured your investments the same way, where we create kind of layers of buckets. At the top, we have a growth bucket. That growth bucket is all about outpacing taxes and inflation and trying to grow your money over the 35 years that you're going to be retired. If we had all of your money in that bucket, however, if you picture the stock market, kind of this up and down, you couldn't live very well because you'd be nervous every time the market went down. Oh, I can't go out to eat or get my ice cream or my steak on for Saturday, right? And so then it would be really volatile for me to try to live. So what we do is we set up a series of buckets below that growth bucket. The middle one is what we'd consider kind of an intermediate bucket. An emergency comes up, you need to go buy a new car, something. It's going to earn decent, but it's not going to be as risky, and it's going to be kind of a middle of the road type of bucket. And then at the bottom of this, we have an income bucket. And in your income bucket, we have enough money that we know for the next 3 to 5 years, you never have to worry about the market changing. You never have to worry about that volatility. You've got your income coming out. And then we put triggers in each of the buckets up above. So when the growth bucket grows, what happens? Ding, 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 right? It tips over, spills down, and then the middle one spills down so that we're never in a position, well, knock on wood, that we're never in a position where we need that income and it's at a time when the market's down and I have to sell at a low spot.
All your buckets are empty.
That's right. Yeah, that's the key, right? You never want the buckets to go dry. And so when you think about how do I structure my investments, when you're working towards retirement, you can be concentrated more towards that growth side of things to try to really grow the balance sheet. But when it comes time to turn that balance sheet into an income stream, now I have to be more intentional with how do I manage those investments. So I'm generating that income, whether it's through an annuity, whether it's through rental property, whether it's through maybe a part-time job if I want to do that or whatever. And how do I have that income come out so that I'm not living my life at the whim of the stock market?
Okay. I feel like every episode I always ask, like, is this an accountant question or a financial advisor? Like, I feel like an accountant and a financial advisor are like can closely work together, or
absolutely.
It seems like that's
the one thing that we always would encourage. So in our world, where the financial advisor comes in when you start talking tax and that kind of stuff, it's really looking forward, and it's saying how are we going to be intentional in doing some proactive planning to try to make sure that over the life of your investments, we manage that tax liability. Where with an accountant, accountants typically are set up to look backwards and to say, okay, let me account for everything that you did do and make sure that we're doing that properly. And so where that marriage can work really well is if you can bring in some forward-looking thought process to the accountant, so that you can really make some good decisions,
and not just this is the result of those whatever decisions you did make.
Absolutely.
Sure.
Absolutely. Yeah. So I think that from my perspective, one of the biggest things can help with kind of that living in abundance, being comfortable, being confident, is if I know I've got my base income covered, I never have to worry about it. I can do a lot of things freely. And
so when we're talking about annuities, like give us some idea, like do a majority of people have annuities? Is it kind of more of a niche, like, oh, you kind of have to be in this right position for it to make sense for you?
I think you're right in the middle. I think that the way that we like to explain or to talk to people about that is you have some people that having that annuity would not give them more comfort,
like peace of mind. Or
Yep, it just wouldn't. And what happens is, if you think about anything in life, if you get a benefit, does that benefit come free? No, you got to pay something for the benefit. And so what happens with annuities, typically they are more expensive than your typical investments or more traditional investments. And so what you're giving up is you're paying a fee in order to get these benefits.
Mm-hmm.
And so as we talk with folks, we try to tell them, though, if you're not going to get any peace of mind from having that, then that's wasted money.
Sure.
If it gives you peace of mind and it will let you live a more free and abundant lifestyle, then that is a fee well paid because it's giving you that peace of mind.
So maybe that's like the place to start when you're thinking about, is an annuity a good option for me? Is, do I value peace of mind? And if I do, great, then maybe we can find one that kind of
then
fits
let's
into
look
those.
At it. Yep.
Like you said, there's a lot of bells and whistles, and you can find kind of the right one that matches. But maybe that's the first place for somebody to start.
Absolutely.
At home, if they're sitting at home now thinking like,
should I? Shouldn't I?
Should I? Is
yeah.
That...
Well, in our suggestion to everybody when they think about annuities, they get a lot of bad rap. If you Google, should I buy an annuity? You're going to have 90 articles that say, heck no, you shouldn't buy an annuity. And 3 that say, yes, you should, right? But it's the same thing as everything else. It's not all bad or all good. It's good in the right circumstances.
Sure.
And so what we suggest is find somebody that is not somebody who makes their living selling annuities, because
of course they think it's a good idea.
Exactly. Yeah. It's good for everybody, right? But rather find somebody that is a tool that they have in their tool belt for an appropriate situation. And so, for example, your advisor should always make sure that your advisor is a fiduciary. Fiduciary is a fancy way to just say that they're looking out for your best interest instead of anybody else's. And so make sure that they're a fiduciary. Make sure that this annuity option is not like, yeah, I know everything about annuities and that's all I do. No, it's just a tool in the tool belt that they bring to the party, because it can be confusing. And the reason that there's 90 don't buy annuities is because articles out there is because there are some bad actors that, not everybody, but that's everything. You got to be careful of what you're getting into.
So basically, people should buy their clothes tailored fit, not just off the rack.
Well, if that's the angle you would like to go with that,
so their financial advice should be tailored to them.
Are you trying to say that I should have that conversation with Alex, or
maybe myself too?
Yeah. No, no, I didn't know if you wanted me to sell Alex on like you had to go get like your own custom fit clothing.
Custom fit clothes.
No. What's the difference between those two? Actually, it's kind of funny you bring that up. It's like when you think of custom fit clothes and a tailor and that kind of stuff, what I think of expense, right? I'm going to pay way more money to do that than if I just go to Target or wherever, Hollister, whatever. I don't know what clothing companies are good now. Yeah, you can tell I have kids at home, right? And so I think that tailor is way more expensive. But what happens is in the financial services world, that doesn't have to be the case. You can go to a fiduciary and actually have your overall expense go down, not go up. And so it's yes, get it tailored, get it custom made. But if it's done well, you could actually see that be more economical for you and it be your specific to you and in your best interest. And just to kind of give you an example why I say that, if you remember, we talked about the benefits of those annuities not being free. Well, if you look at how much the fees are inside of an annuity compared to what the cost is, all in cost for a fiduciary to actively manage your portfolio for you, that difference usually is pretty great. The annuities are more expensive than having that kind of tailored experience. And so if you look at all in costs, if you look at what am I really getting, sometimes, most of the time, I would say, or many times, even if it is a custom financial plan for me, doesn't mean expense. It sometimes can actually mean less expense.
Well, I think that's probably got to be the goal of a financial advisor. If you're in a worse off place after you've sat down with them,
yeah.
I don't think that's...
How about it? It may not be a good business model.
Yeah, I don't think that's a good thing.
Yeah, no, for sure.
Okay, so today we talked about annuities and investment dividends. Is there anything you wanted a final word to wrap up?
I just
cover it all.
Yeah, I think that it really just goes to like if you break it down into phases and you say, all right, am I just starting out on this journey and hoping to build a 2-comma life? Am I in the middle of kind of building that 2-comma life, or am I living the 2-comma life? All of it comes down to, in the beginning, start by putting your money away, start building your balance sheet, focus on how do I build assets. In the middle, you're still building, but you're starting to think about, are there multiple ways that I should be diversifying this? And how should I diversify it? What does a well-rounded portfolio for me look like? And then when you get ready to live that 2-comma life, it's all about, how do I now merge my balance sheet and my income statement to make sure that I've got the right combination of things to give me the confidence so that I can live in abundance and live that 2-comma life.
And that's why you need somebody to put it all together, because you saying all that was like, oh, that feels a little stressful.
Well, I was hoping it was going to be the opposite, because it really can be it really can be pretty smooth and easy to implement. It just takes a little bit of discipline
and education, like making sure you're educated on what decisions you're making.
Absolutely.
Okay. Do we have a question for the mailbag today? Or was our mailbag empty?
Our mailbag was empty today.
Okay.
How could somebody submit a question to the mailbag?
So we need somebody to submit some questions. So you can comment on our YouTube channel, on our Facebook page, any of our posts on Facebook, or send us an email, info@pv-wp.com, if you have a question that you'd like to see us answer on the next episode.
And is that also where they can subscribe, do all those types of things
all
too?
The things.
All the things.
Like our Facebook page, subscribe to our YouTube channel. That will...
Even find us on Insta, right?
On Insta, on Spotify, all the places.
Yep. Awesome.
Everywhere. Thank you so much for joining us on this week's episode. We hope to see you soon.